It's time now for the Wall Street Beat. While overall M&A volumes have risen 16% this year, we are seeing still divestments of acquisitions that didn't work out in recent years. Take Alibaba for an example. It's selling the department store chain in time for $1 billion, and that's 30% of the company's valuation when Alibaba bought it. Bloomberg's Michelle Davis covers deals and joins us, and I remember the first assignment I had at Bloomberg, and it was to calculate the synergies across all of the deals that were done during the boom times, and many of them never came to the announced fruition of those synergies initially announced. So is that a cautionary tale going into next year when you're thinking about those 30, 40, $50 billion deals that are being discussed? Are some of these going to be just a bad idea?
You know, there's that famous line from Warren Buffett, when the tide goes out, you can see who's been swimming in their skivvies. And I feel like that really illustrates what's been happening here. A lot of these deals were struck during boom times, an era of euphoria. Interest rates were at rock bottom. And competition for deals was really fierce. So a lot of companies and potential buyers were really rushing through diligence. They were really rushing through deal processes because they wanted to be the one to buy these companies. But they weren't always taking the time to think about, are the synergies going to pan out? What are the assumptions that I'm basing all of this on? And I do think we're starting to see that happen now with some of these, companies having to really cut their losses. To come back to your question, I do see it as a cautionary tale, but I don't think we're quite in that environment now because obviously interest rates are higher and companies are having to be a lot more sober and reasonable about the types of deals that they're doing. That's why deal environments haven't fully recovered to what we were seeing, 2017, 18 through 21.
Well, we have just over a minute left, but we opened the segment talking about Alibaba. Give us some more examples, for example, because I remember Just Eat agreeing to sell Grubhub. That was a pretty quick turnaround, and seems like they might have taken a bath on that one.
There was another big one that happened during the pandemic time, Teladoc and Livongo. I think they paid around $18 billion for that. They've written off so much of that value. I think Teladoc is now trading around $1 or $2 billion. In the healthcare space, there are a lot of these examples. I mean, CVS is right now under pressure because of some of the mega mergers that it completed years and years ago. And
$70 billion for Aetna.
Yeah.
Wow. Incredible.
And investors right now, they want to see profit. They're not rewarding growth the way they were before. And so companies are just being a lot more thoughtful.